All right, guys, let's talk about what we're gonna go through in this chapter number three. This is one of the most important chapters and also one of the most basics ones. But I advise you guys to take it serious and write your notes and use it as a base for you to start your trading journey. So in this chapter, we're pretty much gonna go to a quick overview of what the master structure means, why understanding structure is key to consistency, and how to connect your entries, exits, and daily bias. So we pretty much start with time frames. You gotta understand which time frames you're gonna use. You gotta understand that higher time frames, pretty much like 1 week, 1 day, are time frame for directions, and lower time frames you use it for precision to get into the trades and understand the difference between bullish and bearish. Identifying when bullish and bearish trends are easy. When you gotta recognize when our shift into the macro structure, when our high highs, lower lows, and learn when to switch bias after market has switched. You gotta understand how to react when the market has changed from bullish to bearish, and from there, pretty much you understand that using uh, fair value gaps and inverted fair value gaps, and this create a lot of imbalance. So we hop into that a little bit into this video, and after we see pretty much this is happening, we start using tools like Fibonacci and other tools that come into place. But I hop a little bit into Fibonacci. This is one of my favorite tools to use in trading, and it's for me it's the main tool that I use on my academy and on my signals and my strategy, and this is what has made me profitable. And this is used for everything in engineering and weather, scientific season, airspace to stars, astronomy, pretty much everything this is used for. So I'm not gonna get really into this in here, obviously, but this is a good video to watch. It's good to know your retracement levels, know to combine Fibonacci with your fair value gaps and all of that tools. And we talk about displacement and retracement. To understand when is a good trade for the market to displace it for a long time. You wanna make a lot of money. You don't want to make a little bit, and obviously you want to make that a lot of money quick. So that's why I was explaining into the previously videos that you want to trade when there's volume. You don't want to trade when there's consolidation. You don't want to trade when the market is like in the same place. Going to one direction. You want to trade when the market is like going up or going down. That's when you make money. So then we hop into premium and discount. This is pretty much in other words like expensive and cheap. When the market it's expensive and the market start doing a retracement, people think it start going bearish. But if the market hasn't take the other low, so this is only a discount level. For example, the market hopped into from 0 to 1.0 Fibonacci and drops down to zero 0.5. So this is a retracement. This is not bearish yet. So it's a retracement and this is a discount. So a lot of people come here, get the discount to go back to premium. So I explained that in there as well. And key level, this is really important for a lot of people. You gotta mark your key level, understand how to mark it, where to find it, and the type of key levels as well. Then here I explain your daily bias. How you find, how do you think the daily is gonna go. How the market is gonna move during the day. So I help you identify how to find that. And then how do you do market analysis and how do you find your A setups? So this is pretty much everything what we'll be covering in this chapter number three. As I was saying before, guys, take this chapter serious. Do your notes, and if you have any questions, you guys just can ask in there.